Hello and welcome back to the Ace of Trades. Thanks for coming out today. If you guys saw my first video about debit spreads and you might have had a question or two, this is just going to be a part two going into a little bit more detail and laying things out a little easier. I'm also going to write out my own little scenario with some super simple numbers just so any of you guys who have been a little confused really get that cleared up and really understand how these debit spreads work. So I have Neo pulled up here. You guys probably know this is one of my favorites right now, but I just wanted to use them as an example because if you did hear me talking about Neo at all, they have a lot of resistance around $40. They've been kind of on a little bit of a downtrend recently since the end of November. And that was from them getting, new price targets that were lower, companies or banks trying to short them, and really have not dropped off that much. I mean, each time it drops significantly, it's recovering, even though they've been getting battered with a lot recently, which really shows the strength of this company. I really don't think it's going to be going under $45, $44 within the next week. I think it'll either be staying around the same amount or going up a little bit. So if I want to trade some options, we'll come in here and we'll see all of our strike prices. And let me just use December 18th because that's what I use in my little scenario I did on my own. And let's say we want to set our buy call at $44 and we want to set our sell call right on top of that at $44.50. The difference between these two strikes is going to be a max contract worth of $50. Everything is multiplied times 100 with options. So 50-cent difference times 100 is a $50 max equity. And we are paying $28 to buy that contract right now. So next week on December 18th, if Neo is at where it is right now, $45, or even anywhere above $44.50, this contract isn't going to be worth $28 anymore. It's going to be worth around $50. So that's a really good deal on a debit spread. And a lot of times you can find these deals if you look at a company that has had a little bit of a downtrend and might just be recovering or had a slightly positive day for the first day in a couple days. Neo's been down the past couple days a little bit, up almost 3% today. So that means that some of these calls are still going down today because it's been on a downtrend. So a lot of these contracts you can scoop up for pretty cheap. For example, this one. And then I also, before I go into my scenario, just wanted to kind of throw a few more in there. Just if we go, say, to January 15th. And I'm pretty positive that Neo's going to be above $50. Let's say above $50. So we'll set our buy call at 49, or let's say at 47, and our sell call at 50. So our spread between the two is a max contract worth of $300, and we could pick that up right now for $98. So if Neo is above $50 on January 15th, which I'd say there's a pretty good chance that's going to happen, this contract will be worth around $300. All right, so I feel like that should help you guys out a little more. Definitely just come in here and take a look for yourself, play around, try to find good deals, and definitely look for companies that are strong and companies that you don't think will drop below a certain price over a certain time. Okay, so I'm going to write out a call debit spread with some really easy numbers just so we can see again how this works. I know I used Tesla as an example for the first video I made about debit spreads, and I might have been a little confusing, and I just want to give you a better example. So I'll write it out with some really simple numbers just so you guys can fully understand what this looks like. So say we have company ABCD. That's the company name. And we want to buy a debit spread that's, let's just say a week out, the 18th. Good decision. trying to make some money, trying to better ourselves. Expire date, we will say, is the 18th. And on the left here, I'm just going to write our strike prices. And let's say the current price is at $3. I won't put any change in there. I'll just make it easy. It's $3 on the dot. That's the cost of ABCD share right now. Strike price, let's say a $2 strike and a $1 strike. So we're looking at doing a debit spread under the share price. So remember, from if you've seen the first video, that's going to be putting in a little bit more money and getting out a little less because you're doing something a lot less risky. So let's say we want to do a debit spread between the strike prices of $1 and $2. That's going to be a low risk spread because I don't think that there's any way that ABCD is going to be below $2 in a week. So let's say our $1 strike price has a cost of $1 to buy a call for the $1 strike price. And let's say at $2, it's 40 cents. Okay? So our $1 call is our buy call, and our $2 call is our sell call. So all we have to do, slide this over to the top, and our $1 call, because that's the buy, will then have the sell call. Oh, forgive my zeros, they're looking pretty bad. Would subtract the sell call from that to give you your cost of a contract, which is 60 cents times always 100 shares in a contract, or the right to buy 100 shares technically, so everything's multiplied times 100. So this equals $60 a contract. Okay, easy enough. Let's redo that. I'm not the best at this, guys, so forgive me. So it's $60 a contract. And our range, our R value, our range is between 0, which is worthless, which we don't think is going to happen, remember, because this is a really safe stock. Our range is between 0 and $100. So in a real world example, your max gain or your max contract worth is $100, and your contract cost is $60 per contract. And within a week, or by the 18th, on the day of execution, this contract worth should be around $100. Now, you most likely won't always get your max gain, but for learning purposes, this is, important to lay all of this out. And that's pretty much it. It does obviously just get a little more confusing when you're skipping a bunch of strike prices, like, if you're doing a $1 call and a $6 call, and you're spreading the range out a little bit. But you can play around with it. I'd recommend going into whatever brokerage you're using, Robinhood, Webull, whatever, and just playing around with this stuff and seeing what looks like a good investment and what doesn't. Now, obviously, this probably wouldn't happen in a real world example. You might pay more like $80, $90 for this contract for a max worth of $100, but that's only because it's such low risk. So it would be kind of rare to find, say a company that doesn't move a whole lot, around $3 a share, setting a debit spread, 60% under the share price and still being able to profit $40 in a week. You probably won't find that, but that is how this works, and that's how you can make money consistently every week playing debit spreads. And you can do this for puts too. You can do put debit spreads for the price of a company to go downwards. So moving on. All right, last thing I wanted to share with you guys for the video, I just wanted to do a put debit spread, just flipping it around for the share price to be going downwards. And another really great way you can do call and put debit spreads is with companies that don't usually move a whole lot over a certain period of time. We could see Ford, rallied a little bit here in the past month, up 9%. But usually Ford doesn't move a whole lot week to week. And we can see this past week has been going downwards, down 3% today. I think this is going to go below $9 next week, and a lot of other people think it is too. So I'd say that's a pretty fair judgment. So if we go into forward options, we'll select puts this time. So we can buy a put. So we're actually, our buy call, or our buy put is going to be on the top now instead of the sell with a call, because we're flipping it around. So our sell strike is going to be below our buy strike. So let's buy the put at $9.50 and sell it at $9. So we could see the current share price is at $9.10. If Ford is at $9.10 next week on the 18th, which is what its current price is at, if it's at $9.10 still, this would still be worth $40 a contract, which is more than the $31 that it costs now. And the max equity is $50. So that's another good way for you to make some money doing debit spreads, is by finding companies that don't move a whole lot over a certain period of time and playing right around the share price. A lot of times you can find some really good deals like this, and some pretty low risk stuff as well. So that's going to be all for this video. I hope you guys enjoyed. I hope I was able to clear some things up and go into a little bit more detail for you. And I hope you fully understand how call and put debit spreads work now. And I hope you're able to go out and use them and make money for yourself, because that's really what I'm going for with these videos. And I'd love for you guys to reach out and let me know if this video helped you and if you've been making some money, and let me know what you've been in. And I'm just really excited to keep making videos for you guys. So thanks so much for coming out, and we will see you next time.